As more data comes in showing a struggling housing sector, the National Association of Realtors of Home Builders CEO, Jerry Howard joined the show earlier today to tell us what they see happening. Listen.
So cost of construction, the cost of capital, it's all playing into it, and that's having an impact where we firmly believe that we're in a housing recession right now.
Joining us now to weigh in on this is Lawrence Yun, National Association of Realtors Chief Economist and Senior Vice President of Research. Lawrence, nice to see you as always. Are we in a housing recession? And how do we define it? We got caught in that trap with the overall definition of a recession recently as well.
Well, good afternoon. I would definitely say we are in a housing recession because it's contributing negatively to the GDP growth. It's cutting into it. Housing starts are down. Home sales are down. There's some layoff in the industry. But the most interesting aspect from consumers' point of view, homeowners, they're doing fine. I mean, they have seen substantial growth in their wealth from rising home prices, very little foreclosure rate, mortgage default rate at historic low. So we have a divergence. People in the industry suffering due to the lack of activity, yet homeowners are doing very well.
So, Lawrence, we have housing starts off 16% from a year ago. Permits are down 22% from 2021 in November. Just in terms of what this is signaling of how much worse the industry could potentially get over the next 12 months. What do you think?
Because of the lack of buyers, the builders are becoming very cautious. Now, we have to remember, we had a housing shortage before COVID. Inventory levels were low. Then the first couple of years during the COVID, when the home sales boom, we had an exacerbated housing shortage with multiple offers widely prevalent. But now with the buyers retreating because of much higher mortgage rates are the drivers. High mortgage rates, buyers retreating, we still have some degree of housing shortage, but definitely it's taking much longer to find that right buyer in order to make that sale.
Mortgage rates up on the screen, and they are down considerably, frankly, from north of 7. That's maybe the only good news right now. Where do you think they settle in at middle of next year?
I would say 5.5% is probably the case because, we have the Federal Reserve who will continue to raise interest rate probably 2 more rounds. But the mortgage rates have already priced that in that information. And with the inflation expected to retreat, from the 9%, 8%, 7%, and possibly 4% inflation by end of next year, that means that the Fed may be able to cut interest rate towards the year end, which means that mortgage rate may be pricing those future possibility into the current mortgage rate. So it could settle down at around 5.5%.
Lawrence, in terms of this weakness that we are seeing in the housing market, I guess how long do you expect that to persist before we start to see any improvement?
I think it's 1 or 2 additional months of low sales activity because, as you mentioned, mortgage rates have fallen for 5 straight weeks. And mortgage rate is always the key leading indicator. And all that will lead to buyers steadily coming back to the market. And if the mortgage rate decline further, as I expect towards next year, then there will be greater number of people entering the market. The key question is whether there will be sufficient supply. Because again, we had the housing shortage, and then housing shortage does not appear to be at the present, but when the buyers come back, we could again face that issue.
All right, we're looking forward to next year, and you're showing us the top markets for real estate next year: Atlanta, Raleigh, Dallas, Fayetteville, Greenville, South Carolina, all pretty much concentrated, relatively speaking, in one portion of the country. What is it that connects these two? What's the common thread among these top markets you see for next year?
2 factors. Affordability. They are relatively affordable, definitely compared to, say, California market or New York. And the second factor is much faster job creation compared to the rest of the country. So a combination of affordability and strong job creation will lead these markets to outperform.
Are these markets that investors are eyeing right now?
There is a more than usual investor activity compared to other markets. Now, the investors are not interested in million-dollar home. They're interested in those starter homes, which they get converted into rentals. So the investors are present, but I think the first-time buyers, they're eager to get into the market. And given that the prices are relatively affordable, if the mortgage rate goes down, continuing job creation in the local area, boom, you have the buyers coming in.
Lawrence, you just mentioned rentals there and what investors might potentially be doing with some of these homes that they are scooping up. When it comes to rent prices, we certainly have already seen a large jump this year. What are you anticipating that we'll see next year?
We have the record high, or I should say 40-year high in apartment buildings right now. So single-family home construction is down. So the home builders are suffering. But the apartment building is at a 40-year high. All this excess supply coming into the rentals market will calm down the rent growth. Rents have been rising faster than 10% in some of the private sector data. Now, CPI has not yet incorporated those information, but now we have turned a corner. Rents are rising, but at a slower rate than before, and this will contribute to actually falling overall CPI, but also the fact that the renters will get some relief next year.